Hold on a second. Let's do it live. I think we're live, Amar.
I don't know. I don't see any comments.
We're live.
Oh, there we go.
Yeah, we're live. We don't have anyone on here yet. Pulverizer.
Pulverizer. There we go.
Oh, he's on your end? We don't have anyone on my end yet. There's no one here so far.
We're not I got to meet Pulverizer at some point. I feel like we'll probably have a lot of things in common.
He's your biggest fan.
He's one of my biggest fans.
Pulverizer, where do you live, by the way? What state are you in? Are you in Philippines? I got a feeling he's in Philippines. Pulverizer. Okay, we got Patty Ballgame. Randy Man's here. Patty Ballgame. All right, as long as Patty Ballgame's here, Amar, you want to start with your and by the way, if y'all want to say where you're coming in from, so Randy Man, where are you coming from? Patty Ballgame. Amar, you want to put in do your disclosure stuff?
Yeah, it's right there. It's on the screen.
You got to read it too?
No, just essentially, we have not entered into a client, what is it called? Client contract, and past performance is not a guarantee of future results. And this is for educational purposes only. It's not actual advice for your specific situation. What about your disclosures, Josh?
Just whatever I tell you to do the exact opposite. So like I sold XOM, Amar, I took a double in the game. And I went and bought UGI, and I quickly lost 50%. So if I buy it, you should sell it. That's just a fact. All right, hey, Sean's in the house. All right, Massachusetts, Iowa. Amar, man, has been a month already since we've last done this?
Yeah, I think so, because my kids had spring break, and so we missed that one. And then we do these every other week, right? So that would add 3 weeks in between.
It's been a month, dude, because I went to Boston. My man, Massachusetts, Patty Ballgame. I went to Boston to see the Celtics. I think the same week you're on spring break, man. So I think it's been a month. Anyway, Well, welcome back. We'll get in the routine everybody. Just every 2 weeks, we'll be doing this over and over again. And do you want anything about what we're thinking about next time about with your partner there, or should we just wait on that? Just the same?
Yeah, maybe next week. We have 2 client-facing advisors. I'm one of them. The other one is Cherie, and Cherie's, focuses on women and individuals, women business owners and stuff like that. So maybe we can get her on the channel as well to just give maybe a slightly different perspective on things that people should be considering for themselves, especially when going through life transitions as well. So that could be part of it as well.
Right on. Nice. So what do you want to talk about, brother?
All right. We're talking about the rise of private credit and equity. So I got a couple slides here. None of these slides are my own. I took them from other presentations. But, I went to one of these presentations and I got, like the headline of the seminar is like, don't miss the boat on private markets, Yeah. And if you look at this, it basically says that growth is not slowing down and private markets are growing. Advisors are intending to increase their allocations to illiquid alternatives right here in the middle. Does my mouse show up there, Josh, when I move it? Can you see my mouse?
Do it again.
Right now. I'm doing it.
No, I can't.
All right. So it's in the middle third right here. And also, clients are looking for illiquid investments. Illiquid investments sound, I don't know what a good, exciting. It sounds like, you're getting an edge, right? But I think this is really just the market and the industry just moving towards this direction because of there's systematic changes in the markets, right? So I want to kind of talk about that. If we look back, private equity has outsized returns, and private credit has outsized returns as well against the public markets. Part of that, I think there's 3 parts here. One, there's an illiquidity function, meaning that when you invest in a private equity fund, usually it's a 7 to 10 year time cycle. So there's no liquidity of those funds for 7 to 10 years. And then there's also a complexity premium, if you will. A lot of these deals are done with attorneys and lawyers, and there's not much transparency, right? So there's a lot of complexity in underwriting these deals and to getting them through. And then also, I think there's been a lot of, I would say interest rate environment has been historically all-time low. So a lot of these private equity funds are using leverage, right? And with low interest rates, they can compound that. And tax-wise, with carried interest, there have been a lot of good years for private equity and private credit.
On the private equity. So are they not? They're not even. They don't fall under SEC, right?
No, I mean some are SEC, but some are just the Wild West.
Exactly.
Like they're making up deals, bundling those deals, and then managing those deals.
Buyer beware, essentially.
Essentially, yeah. But hey, the point of this is that it's coming to retail clients, right?
Yeah. Right.
So I got a slide on that here at the end. So can you move our picture so it's on the side, because I can't see the years here. But basically, when we're looking at companies, a lot of the companies are staying private longer, meaning the small cap space is shrinking, right? And that's mainly because of IPOs, right? Like IPOs were like a huge way to get money. Now we have SPACs, we have all these other ways to access liquidity for companies to grow. And if you're not getting a good large size multiple, like with a lot of these tech companies, then your IPO may not be as successful, right? So we're just seeing a transition or a shift where private markets are keeping companies private longer. So like your average IPO could be a mid or a large size company, right? And then on the private credit side, we're seeing a big shift also in banks, right? So like in 1980, there was about 14,000 banks, right? And then today there's about 4,000 banks. Yeah. And the credit quality of those bank standards are tightening. Yeah. So there's not your traditional bank lender for these type of loans in the credit space. So non-bank lenders have come in, and that's basically private credit. They bundle a bunch of loans together and they take on that risk. And so private credit has been a larger percentage of the lending of the private of lending overall.
These two slides are incredibly interesting. So go back one, will you, Amar? Yeah, so this right here is because SEC regulation is so onerous, and then go to the next one right there. And then you got Sarbanes-Oxley in 2007. So basically what's happening here is you got so many things that are the regulatory environment are so onerous is that they're making more and more firms say, we're not even going to bring it to the public markets. We don't want to be under the banking regulations. We don't want to be under the SEC. And that's why this is such an important topic, is because there's a vast amount of wealth and losses to be had in the private equity. I'm not saying.
Yeah, I mean, when you have a loss on a private equity investment, it's almost going to zero.
Yeah, 100%.
Right? And so if you have credit involved, you may be taking on the company at that point, right? Because equity gets squeezed to zero. Credit owns the assets. Credit will have to hire managers and figure out a way to revamp this. And so that cycle has been happening less and less, right? And so the banks don't want to take on that risk.
Right. I would bet a lot of banks they can't. I bet a lot of banks are regulated from taking on that risk. You see what I'm saying? So that just means it's more open for naysayers or ne'er-do-wells, but also there's still potential for massive profits. It's a big market. Yeah, we keep going tomorrow. I didn't mean to interrupt there.
Yeah. So a lot of the material that we're seeing as advisors from these companies that are trying to pitch us is essentially that, and this is specific to the private credit space, is that private credit does better than public market loans and high yield. The reality is private credit is just junk bonds, right? And it's not junk bonds that are packaged with thousands of junk bonds. It's like, 10 to 15 junk bonds together, and then you're betting on the underwriting of those bonds. The other thing that's different here that I want to make sure that we illustrate is that high yield loans get packaged, with thousands of loans, and then they're sold into another market as derivative products, right? Private credit, the people that are underwriting that debt usually own that debt, right? So that debt doesn't transfer to another party, right? So the underwriting standards for private credit could be more stringent than institutional money.
That's interesting. Yeah. Because they have skin in the game.
They have skin in the game. Yeah, that they're not repackaging and selling it. And I'm not to say that doesn't happen, but that I don't know, Josh, if you remember, not KBS, but there was this famous REIT that everybody was like owning in the early 2000s. Inland Securities of America. It was a REIT that would buy real estate, early 2000s, apartment buildings, and then they would package it, pay a good dividend yield, and then they had a liquidity crisis. They opened another REIT, and then they sold the properties from REIT 1 to REIT 2. And so, there could be all sorts of other issues there. But
what could possibly go wrong?
Yeah. So one of the big things that when people are comparing these private market REITs to or private credit or private equity to public market stuff, you got to understand a fund has to have cash. You have daily redemptions, right? And you have mark to market. Whereas in these illiquid investments, for a long time, they never had to do an appraisal. Then they had to do an appraisal every 12 months. Now it's quarterly, right? And some have to do it more frequently than that based off on transactions of their insiders, right? So here, a mutual fund or ETF will have some cash, which will create some drag, right?
Yes. Right.
And because they have that daily liquidity, they're not buying private market investments because they need to have the ability to sell the investments, right? So institutional grade versus, private market is totally different risk factors here. Even though, this slide is basically saying, hey, you're going to hold a mutual fund for 4 years anyways, so why not take the holding period risk?
So that's, Meb Faber. You ever heard of him, Meb?
Yeah.
So he talks about that. He said he would love to have a portfolio where there's no redemptions that are allowed for 7 years. He goes, I think that's absolutely true. He goes, if I could just run money for 7 years with no redemptions allowed, I said that's that's like a dream world for an investment manager for sure.
Yeah. But and so how is this coming to you? Like, how is this coming to the client? Well, there's 3 ways that this is coming, right? The first way is 401ks are now offering interval funds, non-traded REITs, non-publicly traded REITs, and private equity shares via a closed-end fund, right? So it is coming to qualified plans. Another way it's coming is, advisors or financial institutions like Fidelity, Schwab, whatnot, have realized that if we can get clients in these products that are illiquid, they're going to stick around longer, right? I mean, essentially.
You have to.
You have to, because you can't sell it. And if you try to sell it, you're going to get pennies on the dollar. There is a secondary market for all of these things, but you don't want to go there to sell. It's a bad situation if you have to go there to sell.
Absolutely.
So this closed-end funds, I think, is a big thing. And so what it does is that it allows you to have lower minimums. So typically a private equity fund, you have like a $1 million or $2 million minimum. And here minimums can be as low as $1,000. Mom and pop can invest in private equity and private credit. You typically have lower fees. Private funds typically have 2 and 20. On this side, you're looking just at 2%.
Right.
There's
20% of the gain, 2% annual, and 20% of the gain. Crazy.
On the closed-end funds, there's no K1 reporting. It's typically a 1099. There's no capital calls, so you commit for a certain dollar amount, and that's it. There's no future like you have to add to your investment. It's continuously offered for most of them, and it gives you this access that you weren't able to get in the past. And so like your traditional 60-40, right, where you would have 60% stock, 38% bonds, 2% cash, is now transitioning into something that could look something like this. And this is what advisors out there, this is what their companies are telling them, like, hey, this is the new ideal portfolio. Efficient frontier, we're shifting it to the, would that be right? Left.
Yeah, to the right.
Yeah.
I'm sure it would be.
Yeah, left. It's moving to the left, meaning you can get a higher rate of return with less volatility, right? So, I mean, I don't want to say this is good or bad. Josh, can you take the slides off? Is there a way for you to do that?
Yep.
Yeah. So, I don't want to say this is good or bad, but I have some thoughts here. Rats. I can't see my own notes.
We want me to
can just put it up. Yeah, let's just throw them back up.
There you go.
All right, so it's not good or bad, right? I mean, these are underlying investments that you probably would have owned if you didn't have private equity 20 years ago.
Right? Exactly.
They were probably in your fund, right? But I think there are a couple things that you got to know. Number one, you got to know what you're owning, right? Because you're not selling that to another party. You got to own. You're sticking it for the whole life cycle, right? Speaking of life cycle, funds typically are 10-year. PE funds and private credit are 10 years, 7 to 10 years. In the close-end, you don't have to say the whole fund, but there's liquidity risk, right? So you got to know how long your money is locked up and for how long, right? And liquidity is the number one trap within these funds, because when liquidity dries out, those shares are not worth what you think they are, and I can give you a good example that's recent. Look at all the SPACs, right? SPACs were issued, $10 a share, and they shot up to $90 a share. Those are essentially private investments that are going public to get that liquidity. When interest rates started going up and the markets were not so rosy, a lot of those valuations got cut in half, right? And so, just make sure that you have liquidity. My personal take on this is that, and we mainly work with individuals transitioning from retirement into retirement and in retirement, and then legacy planning. For most of those individuals, if you don't have more than $3 million, it probably does not make sense to take on the risk for the return that you're going to get.
Or the lack of liquidity. I mean, that's just,
well, yeah. Number one, lack of liquidity. Number two, if something happens to either one of you in terms of spouses, then the surviving spouse probably won't understand it and sell it. And again, you'd be subject to redemptions at that time. We've seen that over and over again. Also, liquidity is so in retirement, I believe expenses is the number one thing you can control, and liquidity is number two, right? And if you don't have access to those two, it's going to be very difficult in retirement to have a peaceful night's rest, right? We all know people that have a lot of wealth that can't sleep at night because they're stretched too thin, right? From a liquidity standpoint, especially. So yep, I got we're right on
that. So something that's interesting about the private equity markets, this is on the equity side. I don't know anything about the private credits, but private equity is that because of the burdensome regulations, the Wilshire 5000 now, I think, Amar, is only like 3,800 stocks. You know what I'm saying? Something like that. There is less. We've been knowing this for a long time. The stock market is shrinking because there's so many firms that are going private. They're just being taken private by private equity because of the regulations. And remember when we used to be at USAA, and remember General Robles, he was going head over heels about the banking. Remember that? Like the banking he would get so like the regulations on banking cost USA like, I don't know, $200 million or something. It's just some insane amount of money. And these guys have to contend with all this crap, and they're like, I could just take this private, and I don't have to deal with all that, and I could lock out investors from getting access to their capital with a certain. There's something very appealing from the investors, the guy who's running his perspective in that regard. And I don't think you should just, not you, Amar, but people should just overlook it like this is only for rich people. It is, don't get me wrong, but I tell you, man, as the market gets smaller and smaller, well, what that does, of course, is when supply is lessened, supply is lessened, demand increases, that increases the price for what's remaining, which is why the PEs are higher. But at the end of the day, there is this bigger and bigger portion of the market that is in private equity. So just to say, nah, I'm not touching with a 10-foot pole, I'm not sure I agree with that. Now, I don't have any private equity, I'm telling you right now, but I'm just saying at the end of the day, I wouldn't just, everybody just said, I'm not going to look into this at all, because I think there's more to there's more to it. Pulverizer says, don't go all in. Pulverizer, he bought on leverage the True Social media. True Social. All right, Amar, we got some questions.
Yeah. So just one other comment to piggyback on you is that that if you are thinking of these, right, like we had a list of things of due diligence to be cautious about, things to think about, but also make sure that you have a sleeve that's just cash, right?
Yes.
So if you do have liquidity, you have a safe place to get it, and I think that's true.
Could not agree.
The reason that I think, if you have less than 3 million, that the stuff probably doesn't make sense is the liquidity factor, right? Because your expenses as a percentage of assets, it's going to be, pretty close to break, what the income is coming in. The one thing that the industry has done because of a lot of these companies staying private, right, is the public companies, there's more transparency, right? I mean, that's why you get paid more, because there's a lack of transparency. There's a bugaboo somewhere, right? And then you're hoping that the investors that you have can find it, and then they can manage around it, right? And so, let's go through some questions, and then.
Well, Celtic Spirit says, will higher interest? Well, I guess I could put it up here. Will higher interest rates reduce future returns for private equity? What's your thoughts on that, Amar?
I mean, I think it is a concern, right? That a lot of the private equity gains, or the good years for private equity, were all in low interest rate environments. Not to say that they still can't find a way to create arbitrage now in the future, but I think what will happen is that the good private equity companies will be able to do that, and the ones that were just quote unquote private equity companies will start to struggle. Right. So
the question is, how do you know that in advance? That's the, you know what I'm saying? That's
yeah.
Then he adds on to this: apartment buildings are going up everywhere around me. I wonder if private equity is backing these projects. If memory serves, he lives in Connecticut. My man Celtic Spirit here. Please advise, Amar. Private equity reminds me of the late 1980s leveraged buyout junk bond guys.
Yeah, I mean it's an arbitrage opportunity, right, at the end of the day with most of these. And so, well, at least with private credit, right? Like, so private credit, I think, if you invest in a private credit fund and it's buying in an apartment complex, right, doing the mezzanine financing, right, the financing that the banks won't do, then the worst case scenario is you're going to start to own the apartment building, right, at some point. And so, I would say that's very similar to those leveraged buyout funds in the 80s, mid 80s.
And that was just arbitrage there too. You know what I'm saying? John says private equity is fine for certain people. Most people should stay away, especially seniors without deep pockets. And I would tend to agree with that. I think
that's what
I mean.
Hopefully, that's what I'm trying to communicate.
What I'm saying. Just going to read this real quick. I think the golden age of PE is over, and newer investors average. Yeah, I don't disagree with Celtic Spirit, Mar. He's just saying basically now that when everyone's in on it, everyone's going to be like, I need it. It was kind of like the next big thing, and a lot of investors are going to be taken to the cleaners when they found out. I mean, I've had a couple of clients who've got REITs that went kaput. And I've had other clients make money. I mean, that's the issues. I mean, it's not everything is not all inclusive, but I've had some people that they put X amount of money in REITs, private equity REITs, and they get gone. You know what I'm saying? They got nothing to show for it. And I've had others who are making good dividends off it. So
Yeah, so I think like if you're not an investment expert, right, then you want to make sure that you have companies that have good transparency and good liquidity, and that is in the public markets, right? And so, as an investment advisor, right, like we do a public markets strategy, right, and we do not have a sleeve for private markets, private credit, private equity, but we layer those in for certain clients because there's a diversity component, right? And those clients tend to be higher net worth, higher knowledge base
Yep.
of investments. But if that knowledge base is not there, then public markets are, in my opinion, are the way to go. I mean,
yeah, because it's liquidity. I mean, that whole point. You got, I mean, how many billion shares trade every day? You know what I'm saying? It's crazy, man.
yeah.
Crazy.
So the price discovery, right? Let's be very clear. In public markets, the reason why Josh and I are both pro public markets is because the price discovery is built in
Absolutely.
to the share price.
I cannot
Right?
agree more. Yeah.
In private markets, there isn't that, it's like one laundromat versus another laundromat, a couple streets away. You can see the window cleaners and
That's it. What the hell's that? Is that what it is? A window cleaner? Oh my goodness. Knock on the door. Say, hey, no, don't. Just like that. Yeah. But it's exactly the price discovery. Mar, you're hitting on it. Man, that the ability to just essentially negotiate a price. I will bid and ask. I mean, do you get that in the private markets? And if you don't, then it's all, you don't know what you're buying, man. And it's like, it sounds good. And like, if people want to risk their own money and get the bang for us, fine. But you as a private investor, just Joe Schmo, you're just like, I'm going to give $100,000 to this guy and hope. I don't like that at all.
Yeah. So John Hobbs had a comment here. Yeah, it's mainly a retirement channel, but these products are coming to the retirement space, right? That's why we're having this conversation. I was on a webinar, and the wholesalers or the product people are telling us that, like, hey, this is the future. This is the new 60/40. If you don't do it, other advisors are doing it, right? And I'm telling you, all the people out there, they find this stuff, exciting. It's interesting. It's unique. Heck, it's sexy, right? Oh,
and it's done well. I mean, the numbers have spoken. You know what I'm saying? It's been profitable.
Yeah, like instead of saying I own like an ETF like VOO or like some broad-based index, right? I own shares of this, CarMax. Can you imagine that? You bought shares of CarMax in a private deal, and then there's a story behind it, and I think that's what makes it more appealing for retail clients, and they're coming. I mean, it's in the Secure Act. They're allowing it in 401ks, and in most of these firms are coming to advisors saying, hey, if you're not doing it, other advisors are doing it, and
especially
it's
good. At low return rates, people are always looking for. It's no different than low interest rates when they're reaching for yield. It's the same thing here. It's like, oh man, are you satisfied with 6% on the S&P 500? Look what private equity has done. You're like, all right, it's very alluring, and that's we've never heard this before. You know what I'm saying? It's very alluring. Oh wow, this is something new. Okay, sign me up.
Yeah,
it's like long-term capital management, man. Oh my goodness, they found the elixir. All right, Amar, that's good stuff. What else? If you got any other questions, then any other questions, put them out there. Amar, what's going on in your world here in terms of any other last? We want to keep it to a half hour. Any other last thoughts before we get out of here today?
No, we're not saying private investments are good or bad. Just think of your situation, think of liquidity, and read the fine print.
And no one does.
If you're going to do it. If you're going to do it, read the fine print.
Right on. All right, good stuff. So we'll see you in 2 weeks, Amar. We're going to
2 weeks.
2 weeks. Yeah, 2 weeks. That's what I said. And we'll have a new discussion for you. Remember, every other Wednesday at 1 p.m. Eastern, 10 p.m. Stupid Pacific time, because all the cool kids live on the East Coast. So God bless. Thanks for being here. All right, Amar.
All right. Bye, man.
All right, bye-bye. Cool. Am I still here?